You're listening to the New Jersey Real Estate Investor Podcast. We talk about all topics related to being a real estate investor in the Garden State, based on our experiences with buying, selling, managing, and building rentals. So together, we can all be better investors. Now, here is your host, Pete Tverdov.
Hey guys, this is your host, Pete Tverdov of the New Jersey Real Estate Investor Podcast. Welcome back for another episode, and today I'm really excited to talk to you guys about 100% bonus depreciation. I probably lost half of the crowd already. You guys are sitting in your car or on your couch, and like, what the hell is that? Well, today we're going to dive into that. I'm going to explain to you why this is one of the most incredible tools for real estate investors out there. You're probably going to hear me say this several times throughout the show, so pause for a second and listen to what I'm about to say. I am not a CPA. Okay, so you need to run this by your CPA. But long story short, with the passage of the big, beautiful bill, as some would call it, 100% bonus depreciation is back. And it's incredible, guys. So during Trump 1.0, they passed the Tax Cuts and Jobs Act. And in there, they had bonus depreciation. And before we kind of talk about that, I need to explain depreciation to you guys a little bit for real estate investors. Now, this applies to long-term, buy and hold real estate investors, which is what most of this show is about, right? Like we don't really talk about flipping too much. So normally when you buy a buy and hold rental, you get to depreciate the value of the building over 27 and a half years. And then if it's like a commercial building, I think it's like 39 years, something like that. But for most of you, those of you out there who own a townhome or a two-family, the way the government created tax policy was that, in theory, like your property decays, so to speak, every year, right? So you should be able to write part of that off, which is what makes owning real estate so awesome because you get so many write-offs, right? So normally you get to write off the value of the property over 27 and a half years. So I'm going to give you guys a little example here. And this is a real life example. So one thing I will say, you can't write off land. So when you look up your property or the property you're buying on the tax records, or you could have your realtor do that, they're going to take the value of the property. So let's say you bought a property for $700,000 and the land is worth $250,000. So for my math majors out there, the value of the property is $450,000, right? Because they're saying the wood, the roof, all that over time will depreciate. You can't depreciate land. It's going to be there for thousands of years, millions of years. Well, 450 divided by 27.5 is $16,000 that you get to depreciate every year. So let's say after collecting rent and minus your property taxes, insurance, blah, 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 you were left with $16,000. Then when you apply depreciation, you're on paper, it says you made $0 for that rental. So that's why people love depreciation. Okay. 100% bonus depreciation, instead of waiting 27 and a half years, you front load most of the depreciation in year one. So I'm going to give you guys a real life example. And there's calculators out there for this kind of thing. It's not 100% accurate, but it's a good ballpark. The same property, right? So the same property, let's pretend we bought it in year one, and you get to depreciate it over 27 and a half years. Each year, you get to depreciate $16,000. With 100% bonus depreciation, in year one, you get to depreciate $150,000. How awesome is that? Now, I'm going to talk a ton about this. Under Trump 1.0, it was so awesome that they said, Congress kind of said, okay, well, this needs to sunset. So it's 100% the first year. Then it's 80% the second year, then it's 60% the third year, and so on and so forth until it phased out. Well, he got reelected and there was a Republican majority and they said, this is back and it's permanent. So any property you've bought in 2025 that you bought after January 19th is eligible for this. All right. Now I know if you're still listening, I have everybody's attention. Okay. And again, I am not a CPA. You got to talk to your accountant about this. But this is step one, guys. So 100% bonus depreciation is amazing for a couple of reasons, okay? And I actually, truthfully, I went over pros and cons with this. And so let me give you a couple of really good reasons why. It's so great. Number one, you're going to get significant tax savings. Now, what I will say is, depending on how you're categorized with the IRS, this could either be against your passive income or active income. So if you own a bunch of rentals and you work, at Morgan Stanley, or you're an attorney and you just have passive income, it's still good because you could write this all off against your passive income, but you cannot write it off against your active income. But if you think about it, right, like anybody who saves money on taxes, like you usually redeploy that. At least I do. You redeploy that money to make more money, right? So that's one, the tax savings is significant for people. It encourages capital investment, obviously, right? Like, so you want to buy more property, or you want to buy a fixer upper, or do a development, or whatever it is. It gives you the capital to do that. Some would say it's going to, boost economic growth, which I would kind of agree with. So I think there's a lot of positives to it, for the investors. The negatives really are, well, it's two. The negatives, you could argue one, for the government, a little bit less revenue, maybe. We're getting kind of into like tax theory and politics. We're not going to go there, Pete. Get right back on the street. Okay, perfect. But the second thing that, you have to be careful of is recapture, right? So with depreciation's great until you sell, because then you have to add all that depreciation back, and you might wind up having to pay for it, in the long run. So what I think is very interesting is that they made it permanent. Now, obviously, like, nothing's permanent, right? So like, I don't know how long it's going to be. But what I will tell you is, I've seen this done. It's really popular to do on like syndications, like where people buy like 100-unit building, or they buy, a strip mall, or an office building, or a mixed use building. But you can do it on single family, 2-family, 4-family. Like I see people do it. I have clients who do it. So it's incredible when you think about it. How do you get this 100% bonus depreciation? That's what some of you are probably wondering, right? So they do something that's called a cost segregation study. And what you do is you pay a company. They call themselves like engineers. And I'm not saying that to be rude, but like, that's what they call themselves. And they basically do an appraisal of the property, but it is very, very detailed, to the point your cost segregation analysis is probably about 100 to 150 pages deep. And they break down everything. So they tell you how much the drywall is depreciating, how much the window trim is depreciating, how much the windows are depreciating, the hardwood floors, the carpet, how much the kitchen cabinets are depreciating, the refrigerators, the siding, the concrete, so on and so forth. And they have all these line items. And you'll need that, obviously, to give to your accountant. And then they'll give you like an IRS form with it to give to your accountant, because you can't just kind of, make this up. It has to be legitimate and done correctly. So if you're going to do this, I suggest you find a cost segregation company who's known for this, and does it on a daily basis. With respect to how much it should cost, I've seen numbers on this. This is for 2 to 4 family, between, let's call it $4,000 to $8,000. Now you might be saying, wow, that's a lot of money. And I don't disagree with you. But if you go back to my first example, if you out there buy a 2-family with Tverdov housing, shameless plug for us, right? If I help you buy a 2-family for $700,000, and it's got $150,000 of tax savings, roughly 30% of that, it's about 50 grand back in your pocket. And you spent $4,000 to $8,000 to get that study done. So those of you listening, would you take 50 grand by spending 4 or 8 grand? Yeah, right. The answer is yes. So that's kind of how the cost seg studies are done. Now and I will say, because I've done a bunch of them, my clients have, they take maybe 2 to 3 months to be done. And I think they're pretty cool. They're pretty awesome. Now, you can do it like retroactively, I think, but you have to talk to the cost seg company about that, because remember, this had to do with anything, 100% bonus depreciation is anything after January 19th of this year. So prior to that, I believe it was only like 40% that you could front load. So that's where it kind of got into a gray area of whether it was still worth it or not. I'm jumping around here because there's like so much that I love about this. Pete Tverdov here. If you are a high-paid professional making more than $300,000 a year and you are looking to build wealth and to diversify your investing portfolio, me and my team at Tverdov Housing can help you build a real estate portfolio and earn passive income owning rental property here in New Jersey. We could help you find the property, help renovate it, help manage it, and even help you sell it and buy something bigger and better one day. If you want to build wealth, get some passive income, and have more financial freedom than ever before, contact us today. So there is a catch. There is a catch. Aha! I knew Pete was so full of it, right? I'm listening to this. I'm getting ready to call my wife, tell her we're cashing out our 401k and our brokerage account. We're buying real estate. We're never going to pay taxes again. Well, there's a catch. There's actually two catches. So number one, in order to qualify for bonus depreciation, you have to be what's defined as a real estate professional. And that's defined under the IRS code. And they scrutinize this stuff, guys. So like you can't get cute with this, or you could be opening yourself up to a world of hurt. So here's some of the industries that the IRS would define as a real estate professional. So if you are a developer who is listening, that's a real estate professional. If you are in the construction industry, that's a real estate professional. If you do rentals, if you do property management, if you are a realtor, that is a real estate professional. Now, that should be your full-time job. So I'll make it very easy. Any realtor or contractor listening to this podcast, if you do not own real estate investment, stop what you're doing, DM me, or obviously you don't need me if you're a realtor, go buy rental real estate and look into potentially doing this. Okay. You have a massive advantage. All right. Now, for those of you who work full time, it's challenging because what you're going to need to do is meet two primary criteria. The first is, I think it's like a 50% test. So basically more than half of the services that you perform during the tax year must be as a real estate professional. And you have to keep detailed notes of this, like almost a journal, like, okay, today, January 1st, I did blah, 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 blah. January 2nd, I did blah, 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 in case you ever get audited. And you basically must perform more than 750 hours of service during the year as a real estate professional. And it must be material participation in these activities, okay? So again, the following roles are kind of, and I have this written down, the following roles are kind of defined as safe, but it's if you're doing this full time. So it's developer, it's construction, it's property management, it's leasing, it's being a broker. Some of it's even like, being like a super or doing appraisals. So any of you who are in that world, like you can really take advantage of this and qualify for this as a real estate professional. Now, those of you who cannot, there is some hope. You might not be able to, but what about your spouse? Your spouse might be able to, right? So that's a conversation you have to have with your spouse. And again, guys, I'm not giving you tax advice here. I'm telling you what certain people do to take it. I don't want to say take advantage, but this is what certain people do. They see what's written in the tax code and they follow the instructions, because the government, at the end of the day, guys, the government wants people to spend money on real estate. Now, why would they do that? Why if I buy a three family for 700 grand, would they allow me to depreciate 150 grand of it in year one and save nearly $50,000 in taxes? Because if they do that, I'm probably going to say, you know what? It needs a new sidewalk, right? Now I just paid the mason and his 4 guys. Then I'm going to say, you know what? It needs new siding. Now I'm going to pay my siding guy and his 5 guys. Then I'm going to say, you know what? It needs new plumbing. I'm going to pay my plumber, right? And then my plumber is going to buy the material from where? His supply house. My siding guy is going to buy the material from where? His supply house. So all of this helps stimulate the economy. It stimulates investment. So that's why they do it. They want you to spend the money, but it has to be legitimate. You can't be working, a 9 to 5 or, a 9 to 7, right? And then you're like, yeah, I'm a real estate professional. Like that's not gonna go over well. The other gotcha, so to speak, is even if you are a real estate professional, do you remember what I said earlier about depreciation recapture? So even if you get to write all of this off, eventually, when you sell, you're going to have depreciation recapture. which means you're going to have to add back all this depreciation back in, and it will affect you with taxes. So, another reason why people do this is because they're planning for taxes, or they have certain years where you're having a great year. Like some of you listening to this, you might, in your head, you're like, man, yep, I'm having a great year. I'm killing it, Pete. And that's great. So you need a big tax write-off, right? And then other years, like you don't necessarily need that tax write-off. So you don't do it. So everyone has a different reason for doing it. But I've noticed more and more investors out there buying properties just for the tax benefits of it, because they're a very high income earner. They need a write-off. Their husband, doesn't work. Their wife doesn't work, or, stay-at-home mom, stay-at-home dad. There's nothing wrong with that, by the way. And they say, wow, I think, my wife's going to become an appraiser, or Pete, me and my uncle are going to do construction. Like, cool. Like, do whatever you want to do. So that's what I've seen with people, as to why they do it. The other thing I could tell you guys, that I love about it is, if you're going to develop, you can do a cost seg study on the house, knock it down, build a new house, and then do another cost seg study. How awesome is that? I know a couple of people who do that. The other way you can basically permanently take advantage of this is you just keep doing cost seg studies, and then instead of selling, you do what? You do a 1031 exchange, which I really have to have like a full podcast on, and I will. But a 1031 exchange basically means you buy a property you sell a property for let's say $500,000. You have to buy a property for equal to or greater value, and you roll the proceeds into that property, and you do not pay any capital gains tax. So if you're doing that, you're never really gonna get caught by depreciation recapture. And again, unless you sell and you do not do a 1031 exchange. So some people, like that day that they sell, Uncle Sam takes a huge bite out of their and you got to pay the tax man, because at the end of the day, everyone has to pay taxes. But they do have some amazing ways to help you not pay taxes. And truthfully, this is what got President Trump put under the microscope his first term, right? Because everyone's like, "Where's your tax returns? Where's your tax returns?" And he wouldn't release them, right, guys? Why wouldn't he release them? Because he didn't pay tax. But that doesn't mean he's a bad guy, right? Like, do all of you out there listening want to pay as much tax as you can? No, the answer is no. Even the people in government don't want to do that, right? So all he did was follow tax law. And this is what all really rich people do. And to blow your mind even further, I know some syndicates where they will buy 100 units, 200 units, however many units it is. And then all their limited partners jump in and they do a huge cost seg on it with 100% bonus depreciation. And all the partners get a piece of that, right? So like what person would do that where the return is limited, but they get a nice tax write-off? High income earners, which could be attorneys, it could be doctors, it could be investment bankers, it could be professional athletes, it could be people in the movies, right? And those are the kind of people who invest in things like that. So when I heard 100% bonus depreciation was backed, I almost fell out of my chair, and I was so excited. And I'm looking around like nobody knew. Like the people who know, they know, right? Like if you know about this, you're shaking your head, you're like, yeah, bro, this is amazing. But the people who don't know, right? Like I've just dropped a nuclear bomb of knowledge on your head right now. Like you don't even know what to think right now. So it's back, guys, and it's amazing. And obviously, yeah, it's quote unquote permanent. Nothing's permanent though, right? Like they could change tax law at any time, right? So what I would say is it's not the only reason to invest in real estate, but it's certainly helpful. And you got to remember, even if you're not a real estate professional, you cannot depreciate this against your active income, but you can against your passive income. So let's say you're one of those people, like you have no mortgage. You own like 2 rentals, no mortgage, right? So you have no mortgage interest to write off. You don't have any write-offs. Go out, buy a 2, 3, or 4 family, do a cost seg study, and you could at least write it off against your passive income. So I love bonus depreciation. I think it's an amazing tool. And I have several clients that have taken advantage of it. And, again, I'm very happy to share it with you guys. But again, you do need to understand that you cannot apply this to non-passive income. Okay, that won't fly. And again, like at the end of the day, you have to check with your CPA. So after you're done listening to this episode, you could email your CPA and you could be like, hey, I heard this crazy guy on a podcast. He was like, can I do this, CPA? And they'll help guide you. But those of you, like I said, those of you who are a real estate professional, those of you who are a realtor working at a brokerage, you've been selling all these houses and you don't own rental real estate, shame on you. Honestly, like you're doing yourself a disservice. Or the guy who's laying CMU block, hanging drywall, painting. You got a great company. Like why are you not doing this? You probably don't know about it, but now you do. And that's the beauty of this podcast is I love sharing knowledge about real estate investing. And obviously, this applies to anywhere in the whole country. Even though this podcast specifically is about New Jersey, this has got nothing to do with New Jersey, guys. This is just good old fashioned, awesome insight that I'm sharing here. And what I've been giving you here is like absolute gold. So I really hope you enjoy it. So that's all I got for this one. It's kind of a shorter podcast, but it gets right to the point. So if you guys are interested in real estate investing, buy and hold, in construction, selling, 1031 exchanges, I could help you with all that. Me and my team at Tverdov Housing could help you guys. So look forward to dropping more knowledge with you guys on the next episode. And thanks for listening.
Thanks for listening to the New Jersey Real Estate Investor Podcast. Make sure to subscribe so you don't miss the next episode. Until next time.